Hi friends, my name is CAK Pavan Sandeep, and in this video I am going to talk about inventory valuation. Okay, so the topic in front of us is Ind AS 2, Indian Accounting Standard 2, which is based on International Accounting Standard 2. Okay, the title of the standard is Inventories, and in this presentation I am going to only discuss the scope of the standard. So in this presentation we will discuss about what is within the scope of the standard, what is meant by inventory, and to which assets the standard is not going to apply, what is the objective of the standard, and what is the accounting treatment prescribed by the standard. This is what we are going to discuss in this presentation. So I am going to limit this presentation to discussion of what is going to be covered by the standard and what is not going to be covered by the standard. Okay, so the title of the standard is Inventories. It is dealt by Ind AS 2 and the corresponding international accounting standard is IAS 2. Okay, let's go ahead. Now our discussion will start with the meaning of the term inventory. As per para 6 of the standard, Ind AS 2, para 6 defines inventories as inventories are assets which are held for sale in the ordinary course of business, or inventories are assets which are in the process of production for getting ready for sale, or inventories are assets which are going to be consumed in the production process. Inventories are assets which are in the form of materials or supplies to be consumed in the production process. So the standard defines inventories as assets which can be sold in the ordinary course of business, or we can say assets which are in the process of production to get ready for such sale, or we can say these are assets in the form of materials or supplies which are going to be consumed in the production process. Now let us try to take examples. Now first of all, what is the meaning of an asset? Asset is a resource controlled by an enterprise due to our past actions and which is going to generate future economic benefits for us. So that is the meaning of the term asset. Okay, so we are talking about inventories as assets. Now here the term assets can include both tangible and intangible. That means assets can have physical substance or assets may not have physical substance. We are not worried about that. So if there is any asset, it is held in your business for the purpose of selling in the normal course of business, it becomes part of inventory. You have certain assets which are in the process of conversion, they are in the semi-finished stage, and within a very short span of time they are going to become finished goods and which are going to be sold in the business in your normal course of business. They are also part of inventory. If you are holding stock of certain assets, we can say stock of raw material which is going to be consumed in the production process, production supplies which are going to be consumed in the production process for production of finished goods, they are also form part of inventory. I have given you some examples of inventory. Stock in trade. What is stock in trade? Stock in trade is goods which we have purchased for the purpose of resale in our business. So these are not goods which are produced, these are goods which are procured from others, or the other term is also merchandise. Merchandise means goods which you have purchased for the purpose of reselling. Okay. Then stock of finished goods. We have purchased some raw material and by spending money on conversion of raw material, we have converted the raw material into finished goods and we are holding stock of finished goods. That stock of finished goods is also part of inventory. Then stock of work in progress. During the year we have started production. We have started converting raw material into finished goods and the raw material has not reached the stage. We can say the conversion process has not reached the stage where it can be called as finished goods. They are in the production process. They are not yet complete. In such cases we call them as stock of work in progress or semi-finished goods. Stock of raw material, a factory which is producing finished goods will always hold a lot of stock of raw material because they don't want to stop their production because of lack of raw material. Hence the company will be holding some stock of raw material as well. And also maintenance and supplies and spares. In a big factory there will be a lot of machinery involved and the machinery will require spare parts from time to time. So company would be acquiring those spare parts and keeping them in stock, and as soon as the spare part is required in the machinery, suppose the machinery there is a breakdown, and hence as soon as there is a breakdown, the company is going to use those spare parts for replacing the worn out spare parts and then restarting the machinery. And the maintenance department is going to use nuts, bolts, conveyor belts, etc. whenever they worn out, and then it is used for maintenance of the machinery. So those spare parts are also forming part of inventory as well. Okay. So we have discussed the meaning of inventory. So inventories are assets which are held for sale in the ordinary course of business. So whatever you have purchased for the purpose of selling in the ordinary course of business is part of inventory. Semi-finished goods is part of inventory. Stock of raw material, production supplies, they are all part of inventory. So this is the meaning of inventory as defined by para 6. They may be tangible or intangible. Tangible means the asset has some physical substance, you can physically touch it. Intangible asset means it does not have any physical substance, you may not be able to touch it, but you may be able to only feel the benefit from the asset. Okay, so this is the meaning of inventory as per para 6. Now let us see the classification of inventory as per para 37 of the inventory. These are the common classification. We group. See, a big manufacturing organization may have a huge list of inventory items, and these inventory items we cannot show individually in our accounts. We may group them in certain categories, and this categorization or classification is given in para 37. So we can say the general classification as per para 37 is we may categorize inventory into merchandise, that is stock in trade. We may categorize them into finished goods, work in progress, that is semi-finished goods, production supplies and materials. So as per para 37, inventory can be generally classified in these 5 categories. Okay, let us see some examples. I have the classification as per ArcelorMittal in their annual report 2016. Their accounting period ends on 31st December 2015 and the annual report is prepared in 2016. So as per their annual report in 2016, they have classified inventory. The totals are given to you. Here you are given the classification of inventory into finished products, production in process, that is nothing but SIP or work in progress. Then you have raw material, manufacturing supplies and spare parts and others. So this is the classification given by ArcelorMittal in their annual report for the year 2016. Okay. Next, now let us see some pictures of inventories. So I have taken the example of a steel manufacturing company, and I have tried to imagine what may be forming part of inventory for that steel manufacturing company, and I have come up with some pictures. The first inventory is raw material. So the major raw material for a steel factory or a company which manufactures iron and steel is definitely going to be iron ore. So iron ore is the raw metal which is used for manufacture of steel. So I have shown you the picture of iron ore. It is normally taken out from the earth with the help of mining activities, and then we come to production supplies, limestone. Without the help of limestone, coke, it is not possible to melt iron, and these are used in the blast furnace. Hence I have shown you the pictures of these are not raw materials actually, these are called as production supplies which are going to be consumed in the production process. Then I am showing you some pictures of diesel, petrol or spare parts. So these are all called as your production supplies. Then comes the semi-finished goods. So this is the semi-finished stage of steel. So when you process iron ore, you get something called as pellets. These are small steel balls, or you call them as iron ingots. Okay. So this is the semi-finished stage of the steel manufacturing process. This is how the raw material looks like in the semi-finished stage. Okay. And then we come to finished goods. So ultimate output of a steel manufacturing company is billets. You can see huge steel bars here. You can see coils of steel there. You can see the steel rails which are used for railways, etc. So this is the finished product. These are not the only finished products. These are some of the finished products which are produced by a steel manufacturing company. So I hope you are able to understand what forms raw material for the steel manufacturing company, what is production supplies for them, and what is work in progress, semi-finished goods for them, and what is finished goods for them. Okay. Now let us come to the objective of the standard. Para 1 deals with the objective of the standard. As per para 1 objective, the main objective of the standard is to prescribe accounting treatment for inventory. So how do we deal with inventories in accounting? To prescribe accounting treatment for inventories, this standard has been issued. So this is the objective of the standard, prescribing accounting treatment for inventories. Okay. The primary issues which are going to be involved in the standard, these are the major areas which we are going to discuss in the standard is 1. So the first area we are going to discuss is when inventory is purchased, when stock is purchased, at what value should it be recognized in our books of account. And as per the standard, the basic prescription is inventory should be recognized in our books of account initially at cost. So the first area is when we initially recognize inventory, at what value should we recognize it in our books of account. So measurement at initial recognition stage. The second issue is I have purchased inventory, but before balance sheet date I have not been able to dispose it off, I am not able to sell it, I have not consumed it. Then how should I value it for balance sheet purpose? So the standard prescribes before disposal of inventory, how do you subsequently measure it for balance sheet purposes. The third issue is you have acquired inventory and you have sold the inventory during the year. When you acquire it, you recognize it in your books of account, and when you sell it, you have to remove it from your books of account. So when you dispose of the inventory, how to deal with derecognition of inventory or how to recognize related expense is also going to be discussed by this standard. The fourth issue is, the major prescription of the standard is, on balance sheet date, if you have unsold inventory, you are going to value the inventory at cost or NRV, whichever is lower. So how do we determine cost? Which cost formulas can we use? To attribute cost to inventories, which cost formulas can be used? That is FIFO method, weighted average price method, LIFO method. Which cost formulas can be used to attribute cost to inventories is also going to be described by the standard. And the last issue is, there can be situations where the net realizable value or the recoverable amount of inventory may be below the carrying amount. Suppose the inventory is being carried at 100 rupees and you know that the recoverable amount is going to be below 100 rupees, is going to be only 90 rupees or 80 rupees. So write down of inventory, when to do write down, how to do write down, what is the accounting treatment for write down. And then there can also be situations where the recoverable amount might have increased. Previously you might have written down some inventory below their carrying amount, below their cost, and there can be improvement in economic circumstances where you require to do write back of the inventory. So how to deal with write down and write back of inventory is also covered by the standard. So the major areas covered by the standard is initial recognition, how to do, subsequent measurement, how to do, if you have disposed of inventory, how to deal with the carrying amount of the inventory. Fourth, how to attribute cost to various items of inventory, cost formulas to be used. And the last item is how to deal with write down of inventory when the recoverable amount is below carrying amount, how to deal with it. And reversals of write down, how to do accounting treatment for it is going to be prescribed by this standard. I hope you are able to understand the scope and the objective of the standard. Now let us come to the next part of the standard, scope exclusion. These are certain items to which the standard is not going to apply. Financial instruments. So if I am holding stock of shares, if I am holding stock of debentures in other companies as part of my investment, in such cases those items are covered by specific standards, hence it's not going to be covered by the standard. Suppose I am a businessman who is involved in the business of buying and selling shares. Even though shares may form part of stock for me because I am acquiring an asset with the intention to sell it in the near future, it may satisfy the definition of inventory, but because there is a specific standard, Ind AS 2 is not going to apply to it. Okay. So financial instruments which are held as stock in trade, Ind AS 2 is not going to apply. There is a specific standard on financial instrument which is going to apply to them. Then we come to the next exclusion, biological assets, living animals or plants relating to agricultural activity. So if you are carrying out any agricultural activity and if you have any biological assets relating to that agricultural activity, those biological assets are not going to be covered by the standard. Example, if you are having an apple farm and you have standing apple trees, those apple trees are outside the scope of the standard. And you have a sheep farm, the sheep when it is alive and you are rearing the sheep, in such cases this is not part of the standard. You have herds of buffaloes, you are running a dairy farm, you have herds of buffaloes. In such cases, those buffaloes are not covered by the standard. Output from the buffaloes will form part of the standard, but the buffalo itself is not going to be covered by the standard. Okay. And the point is agricultural produce at the point of harvest as per Ind AS 41. See, suppose you are a farmer, your business is agricultural activity, your company is engaged in sugarcane farming business. That means you grow sugarcane and then you are going to take the harvest of sugarcane, you are going to sell it. That is your business. So when the sugarcane is attached to earth, when it is growing, it is a biological asset. It is not covered by the standard. So a standing crop will be outside the scope of the standard. But once the sugarcane is harvested and it is now ready for sale, in such cases, at the point of harvest, how to value sugarcane, measurement of sugarcane at the time of harvest is outside the scope of accounting standard Ind AS 2. It is prescribed by Ind AS 41. So Ind AS 41 says when agricultural produce is harvested, you have to measure it at fair value less cost to sell. So the initial measurement is at cost. That cost is not determined as per the principles of Ind AS 2. It is prescribed by some other standard. So when you harvest the sugarcane crop, you have to recognize it in your books of account as an asset. At what value to recognize it? Ind AS 41 will apply, Ind AS 2 will not apply. So cost for the purpose of Ind AS 2 would be prescribed by Ind AS 41, which says sugarcane at the point of harvest. Once you have harvested the sugarcane crop should be valued at fair value less cost to sell. which will become cost for the purpose of application of the standard. Now, let us suppose you have harvested sugarcane crop and you are not able to sell, and before you are able to sell, the balance sheet is prepared. Now, should it be considered as inventory for balance sheet purpose? The answer is yes. Subsequent measurement of sugarcane crop after harvest will be covered by the standard, but initial measurement of sugarcane crop at the point of harvest would be covered by Ind AS 41. So that is the difference. I'll give you one more example. Suppose you have a sheep farm. The sheep is now having a lot of wool on its body. The day the wool is extracted from the body of the sheep, the wool which grows on the body of the sheep, the day it is extracted, we call it as agricultural produce. On that day, wool becomes inventory for you. How to measure it? Ind AS 41 says fair value less cost to sell. Suppose the extracted wool, the harvest, is not sold by balance sheet date. On that particular date, we are going to apply the principles of Ind AS 2 for subsequent measurement. Initial measurement cost will not be determined by Ind AS 2, it will be determined by Ind AS 41. Okay. So how to measure the produce from a biological asset, or how to measure harvest, is not prescribed by AS 2, it is prescribed by Ind AS 41. But subsequently they will be considered as inventory and the provisions of this standard will apply to it. Okay. Now, exclusion from the measurement principles, para 345, agricultural produce at the point of harvest. So once you have harvested your crop, how to measure it is not within the scope of this standard, is within the scope of Ind AS 41. But subsequent measurement, they are within the scope of the standard. Okay. Next, commodity traders. Now, who are commodity traders? These are people who buy stock for the purpose of selling it in the near future and to make some profits from short-term fluctuations. So their business is to buy and sell stock to make some trader's margin or to get some commission. Those people are called as commodity traders, and these people are going to value their stock at fair value less cost to sell. So when they purchase, when they acquire stock, they are not going to be covered by Ind AS 2. They will recognize that stock which they have acquired with the intention to sell it off in the very near future. They are going to recognize that stock in their books at fair value less cost to sell. And suppose by balance sheet date they are not able to sell the stock, they will again measure it at fair value less cost to sell. Any difference between the initial measurement and subsequent measurement will be recognized in profit and loss account. Okay. And the next is produce from mining activity. Suppose your business, suppose there is a company which is involved in mining business. They have extracted iron ore, they have extracted coal, and if the normal industry practice for mining companies is to value their output at NRV. So if you are going by industry practice and if you are going to value your output at NRV, in such cases initial measurement will be at NRV, subsequent measurement will be at NRV, and any differences between initial measurement and subsequent measurement will be recognized in the profit and loss account directly. But this exemption, this specific exemption relating to mining activity is not generally used practically. The standard says produce from mining activity which are recognized at NRV and subsequently measured at NRV are outside the scope of the standard. This is what the standard says. The standard scopes out, but practically people still continue to use the prescriptions of Ind AS 2. That is, they will recognize their produce initially at cost, and subsequent balance sheet or subsequent measurement they definitely apply the requirements of the standard, that is carry them at cost or NR, whichever is lower. So standard, even though it scopes out the output of mining entities from the scope, it says if you are a mining entity, you have extracted some iron ore, coal, if you are measuring them initially at NRV and subsequently you are measuring them at NRV, in such cases you need not apply the standard. But practically mining companies continue to apply the cost model which is prescribed in the standard. That means they initially recognize the extracted ore or coal at cost, and subsequently they measure the stock of coal or stock of iron ore which is not sold using the formula, that is cost or NR, whichever is lower. So this is the exclusion from measurement principles of this standard. Okay. Let us go to the next part. Who is a commodity trader? So we can say he is a commodity trader or a commodity broker is somebody who buys stock with an intention to sell it off in the near future, and he wants to make some gains out of short-term fluctuations in the price or the value of those goods. They are called as commodity traders or brokers. So their main intention is to make profits out of short-term fluctuations. Okay. Now, what is covered by the standard? Let us see some examples. Land and for sale. So if you are in real estate business, you are holding some land for the purpose of selling it in the near future in your business. You are buying land, developing it and selling it in the near future. You have the intention to sell it away in the near future. In such case, it will be considered as part of inventory only. Okay. And then we come to spare parts. Spare parts, minor items are inventory unless classified as PPE. So if you have spare parts relating to plant and equipment, you have purchased a very costly machine, and along with the machine you have purchased some spare parts as well. And if these spare parts satisfy the definition of a property, plant and equipment as per Ind AS 16, they will be capitalized as part of plant and machinery, plant and equipment as per Ind AS 16. If they do not satisfy the definition of a machinery, we can say an expenditure which can be capitalized, in such case it will be considered as inventory only. Okay. Then packaged software. So certain software is available off the shelf, which is, we can say, pre-packed in CDs, in pen drives. You can buy them, install them anywhere. So that packaged software will also be part of inventory only. And then Ind AS 105 would apply to inventory which is part of disposal group. Suppose a company is disposing of a division, they are disposing of a group of assets, and in that group of assets you have inventory. So how to value this inventory which forms part of a division which is going to be disposed in the near future? So Ind AS 105 will deal with inventory which forms part of disposal group. Normally it is valued at fair value less cost to sell. This standard is not going to apply. Okay. Next, collectibles, sculptures, paintings acquired for short-term investment. So your business is, you are collecting sculptures, paintings, and you want to sell it at a higher price. When you get a good price, it's still considered as inventory only. And the last is emission rights purchased, held for trading or to settle emission liability within the scope. So if you are a company which is doing a lot of air pollution, and you know because of regulation that you may be held liable for doing the pollution, the company may buy some emission rights, and with these emission rights they may settle their liabilities. So if you have purchased emission rights to settle your emission liabilities, in such cases those emission rights also fall within the meaning of the term inventory. So this is what we wanted to discuss in scope of the standard. Thank you.